Picture this. Jake spends years assembling a portfolio built around dividend-paying investments. He owns shares of Coca-Cola, Procter& Gamble, Johnson & Johnson, along with high-yield ETFs and REITs. Every month, he invests $1,000 into this diversified collection, aiming for an average dividend yield of around 4%. Every 3 months, cash lands directly in his brokerage account. Without thinking twice, he reinvests every payment. It feels productive. It feels deliberate. It feels like he's creating a reliable income machine. Marcus takes an approach that almost seems too simple to work. He opens a brokerage account and invests $1,000 each month into VO, Vanguard's S&P 500 index fund. He doesn't spend hours analyzing companies or comparing dividend yields. He doesn't hunt for hidden opportunities. He simply buys a small piece of the entire US stock market every month and moves on with his life. Both men are 30 years old. They earn the same salary, fall into the same tax bracket, use the same type of brokerage account, and invest the exact same amount every month, $1,000. The only thing separating them is the investment strategy they've chosen. Jake's colleagues enjoy listening to him explain his portfolio. He talks enthusiastically about passive income, proudly shows the dividend payments appearing in his account, and explains why he selected each stock and fund. Meanwhile, almost nobody has ever stood around at a backyard barbecue saying, "You have to hear about my index fund." It simply isn't an exciting conversation. It doesn't sound impressive, and it certainly doesn't make anyone feel like an investing genius. The problem is that emotions and mathematics rarely tell the same story. Over the next 3 decades, reality is going to challenge nearly every belief Jake has about how wealth is built. How is it possible for two investors who contribute the exact same amount of money to end up with dramatically different outcomes, simply because they followed different strategies? And how can someone spend years believing they're consistently winning, while in reality they're quietly falling behind? How can receiving dividend payments feel like undeniable proof that your investment strategy is succeeding, when those same payments may actually signal you're falling behind? How can a steady stream of cash convince you that you're becoming wealthier while quietly reducing the rate at which your wealth compounds? And why does one of the most heavily promoted strategies for everyday investors consistently trail one of the simplest and least exciting approaches available? Fast forward 10 years. Jake's dividend portfolio has grown to roughly $185,000, while Marcus's index fund has climbed to approximately $215,000. Marcus is ahead by about $30,000. The surprising part is that Jake never notices the difference. He isn't measuring his progress against Marcus. Instead, he's comparing today's portfolio with the version he owned a year earlier. By that measure, everything appears to be going perfectly. His annual dividend income has increased to nearly $2,800, reinforcing the feeling that his strategy becomes more successful every year. 20 years into their investing journey, Jake's portfolio reaches around $510,000, while Marcus's account has grown to roughly $620,000. The advantage has widened to nearly $110,000. After 30 years of consistently investing $1,000 every month, the difference becomes impossible to ignore. Marcus finishes with an index fund worth approximately $1.78 million, while Jake's dividend-focused portfolio grows to about $1.41 million. The final gap is close to $370,000. Taxes make the difference even larger. Throughout those 30 years, Jake pays roughly $48,000 in federal taxes on dividend income. Marcus, thanks to the tax efficiency of his index fund, pays only about $3,000. That's nearly $45,000 that Marcus leaves invested and compounding while Jake sends it to the IRS. Historically, dividend-oriented portfolios have delivered annual returns of roughly 9%, while the S&P 500 has averaged closer to 10%. A single percentage point barely seems noticeable over 1 year. Stretch that difference across 3 decades of compound growth, however, and it becomes the difference between ending with $1.41 million or $1.78 million. Let's give this phenomenon a name: the passive income mirage. It's a psychological illusion where regular dividend payments create an overwhelming sense that wealth is growing successfully. Those quarterly deposits provide visible proof that the strategy is working, while quietly concealing a combination of lower long-term returns, tax inefficiency, and additional costs that gradually erode performance. Individually, these disadvantages appear insignificant. Over decades, they compound into hundreds of thousands of dollars of lost wealth. During the first 5 years, the difference between Jake and Marcus is practically invisible. The performance gap doesn't appear overnight. It widens gradually, year after year, in a way that never stands out on any individual account statement. Jake collects roughly $480 in dividends during the first year, around $1,000 during the second, approximately $1,400 during the third, and by year 5 his portfolio is generating nearly $2,800 annually. Every 3 months, cash arrives in his account without requiring additional work. To Jake, those payments feel like confirmation that the strategy is delivering exactly what it promised. Marcus experiences something completely different. By the 5th year, his investment has grown to roughly $73,000. There are no dividend notifications, no cash deposits arriving every quarter, and no visible reward beyond a larger account balance displayed on a screen. By every obvious measure, Jake appears to be winning, but there's an important reality Jake never sees. Every dividend payment becomes taxable income the moment it is distributed, regardless of whether he spends it or immediately reinvests it. Qualified dividends are generally taxed at long-term capital gains rates of 0%, 15%, or 20%, depending on income. Non-qualified dividends, including many REITs and high-yield ETFs, are taxed as ordinary income, potentially reaching rates as high as 37%. Jake owns REITs because of their attractive 7 to 8% yields, but a significant portion of those distributions is taxed at his highest marginal income tax rate. Over 3 decades, this ongoing tax burden quietly reduces his annual returns by roughly 0.5% to 1%. At first glance, that sounds almost meaningless. It isn't. Across a 30-year compounding period, losing just 1% per year can translate into roughly $300,000 of lost wealth. There's another concept that rarely appears in dividend investing discussions: dividend irrelevance. Whenever a company distributes a dividend, its share price generally falls by approximately the same amount on the ex-dividend date. If a stock closes at $100 and pays a $2 dividend, it typically opens around $98 the following trading day. No new wealth has been created. Instead, $2 has simply been transferred from the value of your shares into cash sitting in your account. You still owe taxes on that payment, even though your investment decreased by an equal amount. In practical terms, the dividend functions much like a forced partial sale of your own investment, packaged as passive income. This principle has been well established in finance since Merton Miller and Franco Modigliani formalized the theory in 1961. Yet many passive income discussions rarely acknowledge it, because doing so challenges the narrative that dividends represent free money. Costs don't stop there. Jake's dividend ETFs charge expense ratios ranging from roughly 0.06% to 0.35%, while Marcus's VO index fund charges only 0.03%. The difference seems insignificant in isolation, but over hundreds of monthly contributions and decades of growth, those extra fees steadily compound. None of these individual disadvantages seem dramatic. a little less return, a little more tax, a slightly higher fee. Yet when return drag, tax drag, and expense drag continue year after year, they stop being small. Together, they compound into a loss Jake never anticipated and never noticed, because his portfolio balance kept increasing, and those reassuring dividend checks never stopped arriving. Research consistently points in the same direction. According to S&P's Espiva reports, roughly 90% of actively managed investment strategies fail to outperform their benchmark indexes over 15-year periods. Dividend-focused strategies are not exempt from this pattern. The evidence has been available for years, but the financial industry has little incentive to market an approach that is simple, inexpensive, and difficult to monetize. Investors managing substantial wealth typically organize their portfolios very differently from retail investors focused on maximizing dividends. They generally keep their taxable accounts invested in broadly diversified, low-cost index funds because they're highly tax-efficient. Assets that generate significant dividend income are often placed inside tax-advantaged accounts such as Roth IRAs and 401ks, where annual dividend taxes no longer reduce long-term compounding. They also understand another advantage that index funds provide when passing wealth to future generations. Suppose Marcus passes away while still owning his index fund. His heirs receive those investments with what's known as a step-up in basis, meaning the cost basis is reset to the market value on the date of his death. Decades of unrealized capital gains effectively disappear, allowing his beneficiaries to sell the investments immediately without paying federal capital gains tax on those accumulated gains. Jake's portfolio, on the other hand, has already been paying taxes year after year throughout its lifetime. Those taxes are gone forever. Even if both investors leave behind portfolios worth the same amount, the after-tax outcome for their families can be dramatically different. By the 15th year, Jake's portfolio has grown to approximately $325,000, while Marcus has accumulated around $380,000. The difference has expanded to nearly $55,000. 5 years later, Jake reaches roughly $510,000, whereas Marcus climbs to about $620,000, pushing the gap to approximately $110,000. So what caused this widening difference? The answer comes down to 3 factors. Each one appears insignificant on its own, yet all of them compound year after year. Return drag. Dividend-oriented portfolios have historically produced annual returns of roughly 9%, while the S&P 500 has averaged closer to 10%. Losing a single percentage point doesn't feel meaningful over one calendar year. Stretch that difference across 2 decades, however, and it becomes the difference between ending with $510,000 versus $620,000. Tax drag. By year 20, Jake has already paid approximately $25,000 in taxes on dividend income. That money permanently leaves his investment portfolio, preventing it from compounding further. Marcus, on the other hand, has paid very little because broad index funds generate relatively few taxable distributions thanks to their low turnover. Dividend portfolios often experience an annual tax drag of around 0.5% to 1%, while tax-efficient index funds typically fall closer to 0.05% to 0.15%, roughly 5 to 20 times less. Expense ratio drag. Jake's dividend ETFs charge management fees ranging between 0.06% and 0.35%, while Marcus pays only 0.03% for VO. Although those percentages appear almost meaningless at first glance, decades of compounding turn even tiny fee differences into substantial amounts of money. There's another hidden danger that simple return comparisons don't fully capture. Chasing high dividend yields often exposes investors to greater capital risk. An unusually high dividend frequently signals financial trouble rather than financial strength. AT&T reduced its dividend by nearly half in 2022, despite years of being promoted as a dependable income stock. General Electric cut its annual dividend from $1.24 to just 1 penny. Wells Fargo slashed its dividend by 80% in 2020. Investors pursuing those attractive yields didn't just lose income, they frequently suffered steep capital losses because dividend cuts are often accompanied by collapsing share prices. Jake's strategy assumes dividends remain dependable over time. History suggests otherwise. Dividend-heavy portfolios also tend to concentrate investments in sectors such as financials, utilities, energy, and consumer staples, while allocating comparatively less to technology, the sector responsible for much of the US stock market's strongest performance over the last 2 decades. Without ever making a deliberate choice, Jake gradually excluded himself from the market's fastest-growing segment. The biggest advantage of dividend investing may also be its greatest illusion. Every dividend payment feels like confirmation that the strategy is succeeding, even if the portfolio itself is quietly lagging behind the broader market. Jake could underperform the market by 1.5% annually for 10 straight years, and still believe everything was going according to plan simply because dividend payments continued arriving every quarter. Those cash deposits become a psychological distraction, hiding weak long-term performance from the one person who most needs to recognize it. This effect is remarkably powerful because it conflicts with basic mathematics. Whenever money appears in your account, your brain naturally interprets it as progress. The dividend feels like newly created income, a reward generated by the investment itself. Yet that reassuring payment may ultimately cost hundreds of thousands of dollars in lost compound growth, a cost that's completely invisible during the accumulation years. There's also another hidden risk disguised as safety. Dividend portfolios often feel conservative because they're filled with established, mature businesses. In reality, that perceived safety frequently masks sector concentration. Jake never consciously decided to reduce his exposure to technology companies. It happened automatically as he prioritized dividend yield. When technology became the strongest performing sector, his portfolio naturally lagged behind. What felt like stability was actually a subtle form of concentration risk. Then comes the marketing effect. Dividend investing has become one of the most aggressively promoted strategies aimed at retail investors, and for good reason. Receiving regular cash payments feels satisfying. Financial media, investment firms, and countless YouTube channels have understood for decades that dividends create the emotional experience of earning passive income. What rarely gets equal attention is the mathematics underneath. The illusion persists because the visible cash flow is far more emotionally persuasive than long-term compounding charts. The real mistake isn't owning dividend stocks. The real mistake is believing that passive income should be the primary objective, when the true objective is maximizing total return. Dividends aren't free money. Every dollar distributed comes with trade-offs in taxes, slower growth, and compounding that can never be recovered. For most long-term investors, a more efficient strategy looks something like this. Step 1. Build the foundation of your wealth using low-cost index funds throughout your accumulation years. Whether it's VO, VTI, or another broad market equivalent, this is where the numbers consistently work in your favor. Lower fees, greater diversification, improved tax efficiency, stronger historical returns, and complete control over when taxable gains are realized. It may not be exciting, but it has repeatedly proven effective. Step 2. If dividend investing appeals to you, keep those investments inside tax-advantaged accounts whenever possible. A Roth IRA is an ideal place for dividend-producing assets because annual dividend taxes disappear entirely, while you still enjoy the psychological benefit of receiving cash distributions. Holding dividend stocks inside a taxable brokerage account while unused Roth IRA space remains available can become one of the costliest mistakes many retail investors make. Step 3. As retirement approaches, gradually allocate part of your portfolio toward dividend growth investments to help generate a steadier income stream. The important distinction is that these holdings should complement your index fund foundation rather than replace it. You're not abandoning the strategy that built your wealth. You're simply adapting your portfolio to meet a different financial objective. Retirement further highlights the tax difference. Assume both Jake and Marcus need $50,000 each year to cover living expenses. Jake's dividend portfolio generates approximately $56,000 annually. He doesn't need to sell any shares, but every dividend payment is taxable. After federal taxes, he ultimately keeps roughly $48,000 to $50,000. Marcus must sell a portion of his investments to generate the same $50,000. At first glance, this appears less attractive. In reality, it provides flexibility. Marcus controls when he realizes capital gains and how much he recognizes each year. By carefully managing withdrawals, he can often remain below the 0% long-term capital gains threshold, reducing his federal tax bill to nearly nothing. He effectively keeps almost the entire $50,000. The lifestyle is identical. The tax outcome is dramatically different. And Marcus still has approximately $370,000 more invested and continuing to compound. Who would you rather be? Jake, the investor who enjoys quarterly dividend payments, feels successful throughout the journey, yet quietly sacrifices roughly $300,000 to lower returns and tax drag. Or Marcus, the investor whose statements look uneventful for decades, but reaches retirement with approximately $370,000 more wealth and far greater control over taxes. Jake didn't choose his strategy because he was careless. He genuinely believed he was making the smarter decision. Quarterly dividend payments provided visible income and constant reassurance that his investments were working. He simply responded to the same marketing messages seen by millions of retail investors. How many years of psychological reassurance are worth giving up the full power of compound growth? A dividend was never brand new money. It was simply part of the value of your own investment being transferred into cash, along with a tax obligation. For most investors, investing through a taxable account over a time horizon of 20 years or more, broad market index funds have historically produced superior results. Not by a narrow margin, by a significant one. Ultimately, you have to decide which story you'd rather live. Would you rather spend decades feeling like you're winning while finishing with less, or quietly watch a simple portfolio grow, only to discover at retirement that you were ahead by roughly $370,000 all along?